All right. So before we actually start discussing this reading by door, one thing which is of particular interest to us, and even though that may not be very useful for you for the examination purpose, but allow me to indulge in that because you've already spent a lot of time on those things, and naturally it is desirable that there is a proper finishing to the macroeconomics that you have done. Because what is quite amazing is that the macroeconomics that you have studied in last 2.5 years actually skips the whole financial part. And this was something which was completely exposed after 2008, and most of the prominent economists actually acknowledged. People like Stiglitz has always been saying that, people like Krugman and all said that whatever economics, macroeconomics that we have actually developed after 1980 can be actually thrown into the sea without any loss of knowledge. So why is it that, how is it that we can actually, it was at the face of everyone that the financial sector is such an important thing for the macroeconomic performance, and the finance is something which is completely ignored in our studies. So how do we actually address that? Now, you are aware with the question is not that what is the role of the financial sector in macroeconomics. That is something which is quite apparent, that it has to be given a very, very prominent role. The question is that how is it that we were actually able to do macroeconomics without actually talking about the financial sector and its impact on, in our fundamental understanding of the macroeconomics, the financial sector really does not feature. So how do we actually do that? It's a big lie that we have been living with. And for that, one has to understand the concepts like rational expectation hypothesis, and there is another hypothesis which is associated to it and which is very similar to it. It is called efficient market hypothesis. So what is the rational expectation hypothesis? Rational expectation hypothesis essentially tells you that people will have the correct expectations about the future parameters, future prices, wages, rate of interest, taxes, and so on. They may not have the exact knowledge of it, but they have some kind of probability distribution in their mind about those parameters, the value of those parameters. And that probability distribution actually matches the actual value that is taken, in the sense that the mean value is going to be the same of the actual value of the parameters and what people had actually expected. So this is what is called the rational expectation hypothesis. Remember that what rational expectation hypothesis actually does is that it allows the knowledge of the correct value of the parameter on an average in the long run. But at the same time, it also allows the deviation from those, the long-term value of the parameters. And then that means that since there is a deviation in the value of the parameters, let us say the deviation in the value of the wages from the long-term value, and which means that there can be a actually mismatch between at any period, in any particular period, what individuals think and what is actually there in the market. So that mismatch is allowed for one period, which means that you can have deviation from the full employment. Because, for example, there is certain existing level of real wage rate, but I have a different idea of real wage rate. I think that the real wage rate should be higher actually, because my senior got a better placement, and he was really quite a dud, and I am definitely smarter than him. So why shouldn't I get the placement? And but you don't understand that the real wages have actually gone down in the market. So what happens that you withdraw from the job market, you say, I'm going to wait Maybe I'm going to do some online courses and wait for another job. I'm not going to take it up. So the labor supply actually declines. So because of the perception, the labor supply declines, and because of that decline in labor supply, you can actually move away from the full employment. So that is basically what happens, what gives rise to a different kind of business cycle. But then you have a deviation from full employment level of output. You have a theory for that, and at the same time, the theory also says that, but in the long run, it is going to actually come back to the full employment. It will gravitate towards the full employment level of output. So this is the idea that has been there. Now, what happens that there is another sore point which remains with this version of macroeconomics, which is essentially dynamic general equilibrium models. Dynamic general equilibrium in the sense that you have general equilibrium in one period, second period, third period, fourth period, and that's how you do the analysis, something that you are going to do when you do the master's courses. You are going to do a lot of dynamic general equilibrium models. So in the dynamic general equilibrium models, essentially, there is a demand and supply, and the parameters are discovered, and those. But then there is a future in the sense that one period actually links to the next period, and next period, for example, if you invest in capital, if you invest, then that is something which depends on what you think about the future. So the demand and supply of the goods, the capital goods, will depend on what is your expectation about the future. So there is a linkage between one period to the next period. So one period general equilibrium to the multi-period general equilibrium means that you need to bring in the expectations about the future to actually understand that what will be the outcome today. So how much capital I am going to demand, how much capital will be supplied, really depends on what we expect about the future. So what is the outcome today in the sense of total output and total employment will also depend on what is the expectation, which is expectation about tomorrow. So here now you see that it is, you require a theory which actually tells you that you will have the right prices of the capital. What is the fundamental? I mean, the capital prices, the prices of the capital, prices of the assets will actually reflect their true value. So that is theory which is required. That and do you get the need of this theory? That without this theory, you can't really claim that economy will be at the full employment path or gravitates towards the full employment path, because you can have all price wages flexibility. You may not have the problem of liquidity trap or anything, but then if your expectation about the future goes berserk, then that is going to lead to withdrawal from the capital market, withdrawal from the investments, and then the current output is also going to fall. So the expectation about the future in itself can actually completely play havoc with the current level of output without any actually need for rigidity of prices and wages and those things. So you need a theory which tells you that expectation about the future, expectation about the value of the capital, what will be the value of the capital tomorrow, what is the value of the capital today, does not really go haywire. So there is some anchor to that. As there is some anchor to your expectation about the prices and the wage rate and so on, which is given by rational expectation hypothesis. Similarly, you require some theory for that. And that theory then comes from, that idea comes from, I would not call it a theory because it's really an assumption, it's an hypothesis, comes from what is known as efficient market hypothesis. The efficient market hypothesis essentially has different versions, and it actually tells you that if people have complete information about the future, then they know that what is going to be the income stream out of a capital asset, then the value of the capital asset today will really reflect its fundamental value, and the fundamental value is essentially the discounted value of the future income. So if you have the complete information, then this is going to happen. And then there are other versions which says that insofar to the extent people have the information about the future, the value of the capital or the value of the assets will reflect that information. So that's a weaker version of the efficient market hypothesis. So what it does is that it says that, look, there is a mechanism that is possible through which the value of the capital assets are going to be exactly what they should be. There won't be much deviation into it. There won't be a situation where the share prices crashes or this happens or that happens. Not in the long run. It might happen in the short run. You can speculate, speculation and other things happens. So those things will have an impact on the market. But in the long run, those financial assets and so on will reflect actually their true value. And true value is their earning potential, the discounted future income that they are going to have. And the mechanism through which this happens is essentially the information that the people have that ensures it. So, what all that you have to do then is that provide more and more information to the people. So, as long as people are informed, I think they are going to demand and supply in a way that a exact price, true price, the fundamental price is actually achieved. So this is the idea which actually comes out of the efficient market hypothesis. Any question about that? Anything that comes up to your mind, please ask now. Then after this, then I will be linking it with the deregulation of the financial market. Any question if we have? Is all this clear? Okay. So, is this intuitively, are you not asking question because it is all this very clear, or it is simply not making sense? I mean, both reasons may be there to not ask question. Udbhav, why aren't you asking question? Is it very clear, or it's simply gone above the head? And then also you don't feel like asking question. I can't read that. Okay, let me. You cannot stimulate yourself because, oh, I'm sorry. Let me. Okay. I'm really sorry. How do I do that? I do not know. I actually updated it yesterday, and they have made some changes. And yes, so everyone is unmuted now. So yes, is there any question now?
Sir, I have.
Yes, please ask.
So, sir, in this hypothesis, you also consider things like there are asymmetry of information due to people not having the same expectations about the
Yes.
future and future prices of assets. So what happens then?
Yes, I'll come to that. That there is definitely, that is the issue, because this assumption of a complete information, perfect information about the future is without doubt a very unrealistic assumption. It's so unrealistic. In fact, it is incorrect assumption because it was never going to happen. So so that is a problem area. So what is the policy prescription? How do you actually, when it comes to policy, when it comes to the real world, out of the world of the theoretical model, then what happens? What happens is that essentially you say that, look, this is a market, and in the market, what is the information? Market, remember, is also the exchange of information. In the sense that when I realize that the housing prices are actually in Gurgaon is actually increasing, and they are increasing at certain rate, I do not know why they are increasing, who are the people who are buying it, and so on and so forth. But I look at the prices, and the rate of growth of increase of the prices, and for the duration for which this trend has continued, that gives me certain information about how the market is actually thinking, how market is behaving. So I may have a lot of information which you do not have, but my action of buying or selling gets reflected in the prices, and that eventually then gives you some idea of the information, the type of information I have, whether that information is something which is making me buy or which is making me sell. So even though I do not have the details about the information, the how that information is being used, and using that information, what kind of decision is reached, that is something which can be observed. For example, when someone keeps buying a new dress, then I know that I do not know why she's buying new dress, and what she thinks of her well-being and so on, but I can actually understand that what her choices are. And if I see a lot of people actually buying certain kind of things, then I can actually guess that what will be the demand for that, and so on and so forth. So this is something which happens. This is what a price is, not merely something at which you exchange. Price is also the bundled information, okay, which you can't dissect and find its parts, that why the prices have become like this, but you can actually get an overall picture. But then that is something which is a price is a good price only if there are a lot of people who are actually using their information, they are participating in the market, and naturally while participating in the market, they are using their information to buy and sell. So what is required is that, so I have certain information, Rishabh has certain information, Nikita has certain information, and we all have informations which are different from each other. But we all act according to our information, and all that information gets reflected in the price that is formed. But the point is that that price can be lopsided if there are very few people who are actually making the transaction. A lot of people may have, Udbhav may have a lot of information, but he is not buying and selling in the financial market because he has spent all his money in buying food. So he is in no position to actually spend in financial market. So it will be nice if we can bring in the Udbhav also into the financial market. Then his information will also get reflected here. So what you have to do then is that naturally the world is not according to the model, but then that does not make the model wrong. What you say is that let us try and make the world according to the model. I mean, this is economist solution for the unrealistic model that they give you. That okay, but this model actually works very well. So can't we make the world according to this model? So can't we make the modification, bring it closer to the model as much as possible, and then we will get actually more efficient results. This is the basics of various kind of economic reforms that you see and so see around you, that make the world behave like a model. So how do you make the world behave like a model? What will you do in this situation when you want various people to participate? What will you do? Because that will bring you closer to the world, and then the outcome will be closer to the most efficient outcome that is claimed by efficient market hypothesis. So what kind of policy will actually ensure that? Anyone? If you can speculate. I understand that you have not studied these things, but if you can speculate, that would be nice. Anyone? Rishabh is unusually silent. So why doesn't he try that? What will you do, Rishabh? I hope you can, it's unmuted, so people can actually speak now.
Sir, it's unmuted now.
Oh, yeah. So that was, it's unmuted now. So please, yeah. So please, do you have any question?
Sir, I didn't understand the utility of the dynamic general equilibrium model.
Utility of, uses of.
Use of it.
Yes, you see, you are from economics background, or you have done general equilibrium and so on and so forth.
I haven't.
You have not. So let's actually leave it here. I mean, we can discuss it with you later.
Okay.
Without referring to the general equilibrium, essentially what one was trying to see that the demand supply today, suppose people have all the informations and the markets are very flexible and so on. So the demand supply, all that will actually give you a perfect outcome today. It will be the most efficient outcome. You'll have full employment of resources, but that may not be the case. If you actually have poor expectations about the future, then what will happen that your demand for capital goods is going to decline. And if the demand for capital goods decline, then essentially you may not have all your future all your resources being fully utilized today, simply because we will have you will have people who have the money, who have the resources, they could have invested, but they are actually not investing, and that means that your resources are far from being fully utilized. So this is what I was indicating towards when I talked about the dynamic general equilibrium model. So what you require in the dynamic general equilibrium model, or the idea that I have just discussed, is some kind of theorization which tells you that it is not going to happen that the capital market can crash or something. Why? Because the capital market, the prices of the assets in the capital market will really be reflecting their long-term earning potential in the long run. So, in a short while, for a while, there might be speculations and people may buy and sell, and because of that, there is fluctuation, but eventually it will gravitate towards that. But, that is possible only if people have all the information. But if people don't have all the information, then there might be a problem. But then the question comes that can't we make the real world closer to all the information assumption that we have? So how do we make it closer to all the world, all the information world? I mean, most of the information in the world kind of situation. So for that, we recognize the fact that the prices are the carrier of information. I have just described that. That prices, in what sense the prices are the carrier of information? They are the bundled information. You can dissect it, but then it gives you the overall idea. So, if the prices can be actually, but then that prices will actually carry the information only if that prices is created not just by you, me, and Nikita, but also by Saloni and the Kohika. So, how to bring them into our into our market. That is, if we can bring them into our market, then not only the prices will actually reflect the information that I, you, and Nikita has, but also the information that Kuika and Saloni has. So that is the attempt. So there, I'm asking this question that how is it possible to bring these people into the market so that the prices when that is discovered will be a good prices. Now the fact is that we can persuade Saloni and Koika, but there is no way to persuade Udbhav, because as I said that most of his income he has actually spent in buying food. So he has very little income left, little money left. So how will we actually enable Udbhav to come to the market? What can we do about it? So can you think of some innovative way in which that can be done? Is this has this been is the question clear to you? Does something come to your mind? Some speculative answer, which is fine. Anything? So what you can do is to bring people into the market. One thing is that you would provide them more credit. That is one thing. So why is it that it is getting muted again and again?
No, sir, we are not muted.
I keep saying unmuted, unmute all, and that I did. So I think that should have been.
So
there.
now I can unmute myself. It was suddenly that it gets muted and then it shows an error that you can't.
Okay, I think I have updated, and that is kind of, there is some kind of here that. But now you can talk, right? Yes. So, Saloni, in what sense do you think that we can bring the model closer to the reality closer to the model? It's the other way, the reality closer to this model. How will we actually ensure that more information from more people is actually pooled? So, one thing which I suggested right now is that you give them more credit. So that will actually is going to be helpful. What are the other ways in which you can think that can be actually done? You know, yesterday we did discuss about the derivatives. Now, derivatives are the instruments. So what happens that we all know that Rishabh is very smart and he has all the information and so on. But then, you know, he does not have much saving. So he can't really invest a lot in shares. But what he can do is that if he wants to go to buy shares, there will be very few shares that he will be able to actually buy. So, but what he can do actually is why it is actually by default it is allowed. Okay. Okay, I think now you will be able to unmute. All of you will be actually able to unmute because I have ticked on something which says allow participants to unmute themselves. So I think now this problem should be over.
Yes, it's working now.
Yeah, yeah. So just continuing with what I was saying is that you know, if you our intention is to bring as many people as possible into the market. So if we allow Rishabh to actually invest in derivatives, then what he can do is that instead of buying shares and selling shares, he can actually invest in an instruments which is betting on the value of the share. And something which I described yesterday, that I have an arrangement with someone. I had an arrangement with Pakiza that you know, I'm going to buy 10 shares from her at 1,000 rupees on this particular date. And it is not that the Pakija has those shares, but you know, at that price he is going to actually give me those shares on that particular date. Now the price that is fixed is 1,000 rupees. Now if the price actually turns out that it is only 900 rupees, then what is going to happen is that Pakiza is supposed to give me, because he's supposed to lose money buying things, she's supposed to gain money buying things in 900 and selling to me in 1,000. And so there is a gap of 100 rupees, and then there is a agreement for 10 shares. So basically, you know, I will be losing 1,000 rupees and she will be gaining 1,000 rupees if we actually, there is a sale and purchase of the share. So, but instead of doing the sale and purchase of the share, what we do that we settle it amongst ourselves, and you know, I give her 1,000 rupees. So this is an instrument that is being sold. Now what is happening is that, you know, we are actually participating into the financial market without having the purchasing power to influence much, because you know, our purchasing power is really, you know, we have only 1,900 rupees or 1,100 rupees. We don't have that much money to buy many shares. But what we are doing is that we are trading in derivatives. Now, the important thing is that definitely the value of the share is going to have an impact on the derivative price. As a matter of fact, the price of derivative is derived from the value of the shares, that we know. But what happens, that it's the other way also, that the transaction that happens in the derivative market, if there is a huge demand for derivative, if people are actually speculating on the share of certain companies, they're not buying shares, but they are actually betting on it. They are saying that, look, we are actually, I can get into an arrangement with you that I'm going to buy this at 1100 rupees after 3 months, because I'm sure that the prices are actually going to become more than 1100. So, I have that expectation. Now, that expectation then will have actually the impact on the share market itself. The for that particular company, the share prices will be impacted by that. And why it is impacted by that? Basically because now people say, okay, fine, I mean, this chap is actually willing to buy it in 1100 rupees. So today, if I actually buy it in 1050 rupees, then I'm going to make that much money. So let's do that. So people will actually buy shares so that they can actually, sell it in 1100 to me or to anyone who is interested. So if the derivative prices actually increase, then that has an impact on the share market also. So it's a two-way relationship. The share prices increase will cause the derivative prices increase, and the derivative prices increase will cause the share prices increase. So if you are and the decline, I mean, it's in the either direction. So what is happening? What is, we are actually trying to make a point here. What is the point that I am actually making? The point that I am making, that anyone who is simply participating in the derivative market, and the derivatives are not really any kind of, the value of the capital as such. Those are the shares which actually represents the value of the capital. But anyone who is actually trading in the derivative market is sharing his or her information, revealing his or her information, in the sense that if I am buying, then that means that I have the information that actually, things are going to improve. If I am selling, then I have the information that things are going to worsen. So, by acting in certain way in the derivative market, I am actually giving a signal about what I think about, what kind of information about I have about the derivatives. And that information about the derivatives then will actually reflect in the share market also. So my information has an impact on the outcome in the share market. The share prices will increase if I have the information that the conditions are actually going to be good. So if I have the information that the China is going to be worse off and India is going to take over the global supply chain, then I'm going to invest in Indian market. I mean, this is what our Prime Minister has assured us that that is going to happen. So we are all going to get Apple phones in 20,000, the latest Apple phones and so on. So let's be happy about it. And of course, there will be a lot of jobs. So that's the best thing. So what is happening is that the information of the even if you get people into the derivative markets or other kinds of instruments market, they come up with some information, and that information then has an impact on the financial assets which underlie some real assets. And so in some sense that information is getting used. So what is happening is that by bringing in more people and allowing for all kinds of instruments and providing them with a lot of credit, you are actually getting more and more people with their information into the financial market. And then the assets, the financial assets will be actually reflecting their true earning potential. So underlying of the financial asset like shares, the primary financial assets, you have an underlying real assets. So, if the financial assets are actually reflecting the true value, true earning potential, or they're closer to the true earning potential because of the pooling of information, then the value of the demand and supply of the real capital will also be impacted by that. So that is the idea. So in some sense, what efficient market hypothesis tells you, it does not describe you the world, but it tells you that how you can make the world to be. If you get into this direction of actually having more and more transaction, getting more and more people into the financial market, then that would actually allow you to get closer to efficiency as predicted by the efficient market hypothesis. So that is the idea that I was trying to convey. So you see that how something in the macroeconomics, because that is the point where we started, is actually telling you that go for more and more financial liberalization. And as far as the macroeconomics textbooks are concerned, it says that, look, we really don't have to bother about the financial market, because essentially what is best for the financial market is known to everyone. You liberalize, you allow as much trade, you allow all kinds of instruments, and that means that there will be a perfect or near perfect or tending to the perfect information environment, and in which this is going to function. So this asset market is not a source of problem. So while we are doing our macroeconomic model, while we are doing our Dorfman Solo Samuel, Donbus Fisher and so on, we can actually jolly well forget about the financial market and concentrate about the other macroeconomic things which are otherwise not very apparent. So this is the idea that is being. So you see that there is certain thing in macroeconomics that we have done, or certain things that we have not done, which is what becomes the basis of the financial regulation. So your macroeconomics that you were taught, after all, was not that innocent. All right. I think I will just. What is the time? If you have any question, I will take those questions, and I will not continue with the class because, as I said, that unfortunately I had some work, so unavoidable work. So we started late, and now it may not be actually possible to cover substantial portion of the door. So we'll be taking that up tomorrow. But if there is any question from what we have just discussed, then I can take it up. Or maybe if you don't have time,
Sir, I had a question. The fact that they will bring changes in the real supply and demand, which might not really be true.
Why?
Because it's simply that you are, providing credit to the people, and you're simply increasing the demand over here, and which is inflating the prices or bringing changes. So would it really affect the, the real goods economy?
No, it will not. It will not affect the real good economy. You look. I mean, it's supposed to affect the real good economy. Whether it will or not is a different thing. I am here. I was actually not describing that how the world actually is going to function. I am describing that how these people put that you can make the world function like that. So you can be critical of it, and you can think of different ways that in which this will not hold true. So I'm sure that there are multiple other ways in which one can think about it. If there are certain other things in which you think that there is actually loophole in this whole formulation, then that would be actually good. If you work out the detail, I think even you can actually write small paper around that. So that would be a good. So please do think about it. I think
the point is that the idea of reaching to the efficient market itself is that we want full employment back, and the kind of situation that we wanted. But how will we get through it if we don't affect the real goods economy exactly over here?